Okay, so now we're going to move on to accrued expenses. Accrued expenses are the opposite to prepaid expenses. So with prepaid expenses, we've had the situation where we've paid for an expense and the expense has been paid in advance. So at the end of the accounting period, the expense needs to be decreased by the prepaid amount. With accrued expense, at the end of the accounting period, you've identified that there are expenses that are owing. We've received the benefit for that expense from the supplier, but we have as yet not paid for it. So that service that we've received by the supplier has assisted us in generating a revenue, so that expense needs to be matched to that revenue in the current accounting period. So accrued expenses are costs incurred by a business in the current accounting period that have not yet been paid. So what are some examples? Rent and wages are classic examples. This doesn't necessarily mean that the business is overdue in paying them. It's just, it just means that we've received the benefit for a service and perhaps that service doesn't need to be paid for another couple of weeks or another week. So it's not that we are being tardy, it's just that that's how the situation exists. So let's have a look at an example. During the 2006-2007 financial year, the business has paid $25,500 in rent. So that's the total amount that we've paid in rent. On balance day, which is the 30th of June, rent is owing of $1,200, but we won't pay that rent until the following week. So remember, that's probably just when the rent is due the next week, but we have consumed the benefit of those premises in the current accounting period to the value of $1,200 that needs to be recognised in the account. So here's our rent expense account demonstrating this payment. So at the end of the accounting period, the entries to date amount to $25,500. So that may be the sum total of perhaps 12 separate entries, and this is how we're representing it in the account at this point here. So let's consider these points here. On balance day, rent is owing of $1,200, but we won't pay it until the next week, and the next week happens to be in the next accounting period. So according to the principles of accrual accounting, that expense of $1,200 is owing on the 30th of June, and we need to include it in our profit determination. Even though we haven't paid for it yet, if we're applying the matching principle, we must include that $1,200 in the rent account because it represents an amount incurred in the current accounting period. So the rent account needs to be adjusted so that we can reflect the true value of expenses of that expense that's been consumed in the current accounting period. So the general journal entry that we are going to perform then to allow that to happen, rent as an account is an expense. To increase it, we need to debit it. So we'll debit it by the accrued amount. Now we need to credit another account, and as you've probably guessed, the other account that will be credited is accrued expense. Now why are we crediting this? Obviously so that to allow the double entry to be performed, but also it's credited logically because this represents an amount that is owed. So this is a liability account, the accrued expense, that's why we're crediting it. So this double entry is going to allow us to increase the rent account by $1,200 because the amount has been incurred in the current accounting period, and it will allow the raising of the temporary liability account, the accrued expense account, to reflect $1,200 that is owing by the business to the landlord. So it's a liability because the business owes this amount for rent. So let's have a look at the effect the double entry will have on the accounts. Here's the liability account that has been raised. Rent expense was the other account affected. The liability account is being credited by $1,200. The expense account, there's the $25,500 sitting in there that represents the amount that's been paid during the accounting period, but $1,200 needs to be added on because that $1,200 represents an amount towards the end of the accounting period that has been consumed by the business but won't be paid until the next accounting period. And accrued expense is the other account affected there. So you'll see here that arrow should be pointing down there. This $1,200 will appear in the balance sheet as a liability in the liability section, and this 26,700, just pretend that's pointing down here, will be closed off to P&L summary. Now, same thing happens just like with the prepaid expense. The very next day we need to perform a reversing entry. So where we debited rent to increase it, we are now going to credit it to decrease it. Accrued expense is 1,200 and that needs to be debited because we no longer need that liability because it won't be owing. That 1,200 will not be owing by the business in the next accounting period because we will have paid for it. And here's the effect of the reversing entry. So in the accrued expense account, the reversing entry will have the effect of removing that liability from the books of the business. In the rent expense account, you'll see here how the account was closed off at the end of the accounting period for 26,700, including that 1,200 amount that was accrued. The reversing entry here has the effect of crediting the account. Now remember, this is an expense account, so we don't normally credit expense accounts, but in this case we do. And let's think about how that will affect the balances coming up. The very next, at the end of this week, remember that exists, that accrued amount exists because last year we acknowledged that, last accounting period we acknowledged that we won't pay for that until the first week into the next accounting period. So when we do come to pay for it, in this account it'll record bank, probably at the end of the week, bank, 1,200, debit. Now, that 1,200 doesn't belong in this new accounting period. It was consumed last accounting period. So you can see how the effect of this reversing entry will have on that balance. It has a 1,200 credit balance here, but when we come to pay for the rent in the new accounting period, this will go down to 0. And that's perfect. It's exactly what we want because that 1,200 that is paid for in this accounting period belonged to the last accounting period. So just like that 1,200 belonged in this accounting period, when we do pay for it in this accounting period, it does not belong here. So we want it, we don't need it to be sitting there. Otherwise, at the end of the accounting period, remember what's the point of recording information in the expense accounts? So that at the end of the accounting period, we can record in that account a balance that represents the expense for that period. This 1,200 is not an expense for that period, it's an expense for the previous period. So it will decrease any balance in this account by that 1,200 amount that belonged to the last accounting period. So what we have here is this account here is now closed, so my arrows are a bit weird here. And this balance here of 1,200 has been returned into the account and it represents the rent amount which will be paid in this current accounting period, but it was owed in the previous period. So it really doesn't belong here. And the reversing entry will allow us to take it out. So that's accrued expenses.